And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Money continues to pour into ETFs, particularly into equity ETFs, not so much into bonds, though. Let's talk with Charles Ellis. He's the author of the investment classic, Winning the Loser's Game. It's out tomorrow in an 8th edition. Dave Noddick, my old friend from ETF Trends, joins us as well. And Charlie, it's very exciting to have you on. I have known you for so many years. I've known your book for so many years. And yet we've never had you on CNBC before, to my knowledge. I found this in my library, Charlie. This was the 1998 edition of Winning the Loser's Game, which I got when I came down here in 1997 or 98 or 99. I got it, but this is the 1998 edition, and then the 8th edition is just out. Congratulations. It's a real investment classic. It has had a lot of influence on me personally. For viewers that are not familiar with your book, Charlie, summarize the findings of the new edition for us briefly. Your key points are that the evidence for investing in indexing in particular continues to get stronger and stronger. And can you summarize that evidence for us now?
Sure. You can look at it two ways. One is top down, the other is bottom up. Top down, you look and see over a reasonably long time period, 15 years, 20 years, how many active managers beat the market index that they chose for themselves and had free time to organize. The answer is somewhere between 10 and 15%, Bob. Only 10 and 15%. The ones that fall short by a great deal more than the ones that happen to win, get ahead by. So the odds are stacked against you very badly. The second thing you do is take a look at the data and work up from the specific facts. All kinds of changes have taken place in the investment management world. Now information is available to virtually every participant at exactly the same time in complete disclosure. So that's because of Bloomberg terminals. It's also because the SEC has made it a law for now a dozen years that if any investor gets any useful information for making an investment decision, that listed company is responsible for being sure they've done all they can to get that same information to everybody else. And when you make changes like that, it's no surprise that it's very hard for people to overcome cost of operations, the fees, and then, of course, for every individual investor, the taxes that are added on. Indexing doesn't have those kinds of taxes because it doesn't have that kind of turnover, and therefore, we get competitive advantage. ETFs and index.
Dave, any argument with that? I mean, the data, of course, is overwhelming, as Charlie says. Yeah. Morningstar does this. S&P does it twice a year, and they've been doing it for 20 years. I don't know if we can dispute any of this at all. It seems pretty clear to me at this point, but is there some finer point we need to put on this?
Yeah, I mean, just, having been a student of Mr. Ellis's book for, decades at this point, I go back to those sort of sources of active management, right? And certainly when we think about stock selection and market timing, obviously, I completely agree. The data is the data. Every once in a while, you'll end up with a rare pocket of outperformance. So, for instance, over the last 5 years, high-yield bond managers have been able to do slightly better than CoinFlip. But it's hardly, some sort of raving endorsement for the active managers in that space. But the third source of active management is that asset selection. And I think that's the one where a lot of investors are really hung up right now, particularly because a lot of the old saws, even amongst passive investors, have revolved around things like what is your equity to bond mix? What is your home bias versus your international and emerging markets exposure? And I think a lot of investors don't think of those as active management decisions, but boy, they really can be, even if you're only implementing them with low-cost passive ETFs.
Yeah. What about that? What about that, Charlie? Go ahead. Put your 2 cents in here on this.
It's really important for every single person. Active examination of who you are, what your problems are, what your opportunities are, what your resources are, how long you've got to be invested. Figure out what the problem is, and then work to figure out the solution. That is active, and it really pays if it's done carefully and well. And if you can't do it yourself, get an investment advisor who will take you through the process. That's active at its best.
Yeah, but Dave brings up an interesting point, that a component of active investing these days is to decide your asset mix. Now, you have been a proponent of broad diversification in index funds, Dave's trying to, I think, make a point that a lot of investors today have choices, particularly even with ETFs these days, so you can overweight technology stocks. You can own, recently, there's been a big craze for what we call thematic tech ETFs, which is investing in cybersecurity or investing in climate change or investing in anything that's perceived to be a growth-oriented mode. Is there any evidence that doing any kind of anything other than broad index investing outperforms at all?
None that I know of.
You know, not to get too technical on Fama French models, but there have been studies done over decades looking at factors, including value investing, small cap investing, for example, or investing even by earnings growth. There has been some evidence that value outperforms over growth. Small caps outperform over long periods, although that has not happened in the last decade or so. Are you at all supportive of any of those kinds of factor type investing?
I'm not opposed to the concept, but it requires an extraordinary amount of skill and patience, because factors don't come along and announce themselves. You have to be waiting for them, waiting for them, waiting for them. And by the time other people see, oh, look, such and such a factor is really working, it's probably over. I'm not an enthusiast factor investing, but I do know people are good at it, and I'm willing to let them play that game.
I love talking to the active investment community because they get very defensive about this. I mean, they're always sort of like, what are you implying, Bob? I'm not worth the money. I work very hard. They sort of imply, well, I'll admit other people don't do very well, but I worked very well, and somehow I'm outperforming. And when you really press them, they seem to get annoyed over the idea of passive investing in general. They seem to think it's, you've heard this word un-American, that it's wrong to just be average. You're supposed to swing for the fences. And then there's the argument, well, Bob, active investing must work because if it didn't, all the active managers would go out of business. What is wrong with that argument? You make a point of that in the book of addressing that.
Well, lots of people would like to see active investing work. When I was a child, my mother read to me The Little Engine That Could. And the little engine struggled, I think I can, I think I can, I think I can, and made it to the top of the mountain. And that was wonderful for child play. And then when I was in school, I learned that if you do your homework, you're going to get better grades. And in sports, if you work harder, you'll get in better shape and you'll be able to perform better. Many of our life lessons are if you do more homework and work harder and try harder, you'll do better. And that's often true. But there are some parts of life where that just isn't the case. And candidly, in today's contemporary world, investing for most of us, active doesn't really help, and it does harm.
Yeah, and Bob, I think the other piece here is that, you know, I don't think even Charlie would say that there is no active manager who has ever outperformed. That's not the case. It's just that the average active manager consistently underperforms. But, you know, even if we think about something like U.S. large cap growth, well, there's still 10% of active large cap growth managers who have a 20-year market-beating track record. Now, we can argue about whether that 10% is coin flippers or true skill or true insight and an ability to sort of manipulate models effectively. But that's part of why we always have this hope that springs eternal, because, you know, we can line up 100 active fund managers and 10 of them, in fact, have incredible 20-year track records. The problem is finding that person for the next 20 years turns out to be a bit of a mug's game.
Yeah, it's incredible to me. You know, people ask me, well, why do people still invest in active management? Because, as you point out, Charlie, active management investment products are sold. They're not really bought. One of my favorite stories in your book, you've been using it for years, and I often tell this story about the fisherman who goes into the bait shop and he sees all of these very gaudy fishing lures sitting there, multicolored fishing lures, and he goes over to the manager and says, do any of these fishing lures actually catch fish? And the manager says, we don't sell the lures to the fish, meaning we don't have to have the fish convinced that they should bite at it. We only need to convince you, you're the fisherman, to buy into it. That's a great story. I always use that story as an indication that people are sold these products because they are sold them by people who are very good at convincing people that they ought to be buying them.
And the truth, I would like to be convinced that somebody is really so good that they'll be able to succeed. So we're guilty in part ourselves. It just, if you stand back from what people are saying and all the excitement of a particular time period and look at the history over time, you'd say there's no way that this isn't going to work out to be really hard for active investment managers on an operational level. And therefore, it's not a game I want to play. We're talking about real money. And if you're saving for retirement, or you're saving for your kids' education, or you're saving to buy a house, that's real money. It has importance for you. You ought to play sensibly with it.
Yeah. I want to just focus on the key parts of your book. Dave, I'll get you back in here in a minute. But the elements of long-term investing here, which I picked up 24 years ago when I got your book, but it's worth repeating: using index funds over active investing, broad diversification, and pay very close attention to the fees, expenses, taxes, and stay focused on the long term. And Charlie, the key message here is make less mistakes than the other guy. That's the whole point about, there's an explanation about what the loser's game is, but I don't want to get into it. But I think the key point here is focused on the long term. And the problem with investors is they get scared very easily. How do you convince people who are 55 years old and suddenly is a 20% correction to stay the course? It's that stay the course thing that's really hard.
It's very difficult. It's a real challenge, and it takes active engagement with yourself to know who you are and set up a portfolio that you can live with and accept the ups and downs. But when you look at the portfolio, don't look at it just as a securities portion, because all of us have other things that are going on. At some age, Social Security turns out to be a really important part of your total investment picture. At a young person, the really big part of everything that has to do with their finances is their ability to earn and save money in the future. And if they happen to be very talented and they happen to have good education, they're going to have a substantial capacity to save. They should recognize that and use that as part of their thinking process. Anybody who owns a home should recognize the value of the home is at least as important as the other things in your total portfolio financially. And if you look at all those other components, they're pretty stable. And when the market goes up and down, if you just keep your eye on the total picture, you're going to be much more able to stay the course and get the long-term results that come out of being a long-term equity investor.